and welcome to today's RIMS webinar sponsored by Global Risk Consultants, a company of Tuve Sud Group. This session is titled Asset Valuations in 2025, Managing Tariffs, Inflation, and Rising Insurance Scrutiny. I am Justin Smollison, Business Content Manager here at RIMS, the Risk and Insurance Management Society. Welcome. A few notes before we get started. If you have a question for the presenters during today's session, please submit them by writing in the question box. The Global Risk Consultants team will reply to you during the Q&A portion at the end, and for those we cannot address today, the GRC team will reach out to you directly. Following this session, the recording will be available through the on-demand events page of rims.org, and all downloads and contact information will be accessible to the sponsor. On with today's presentation, insurance carriers are still scrutinizing property values despite market softening. Outdated numbers can put your company at risk of underinsurance or worse, an uninsurable submission. Global Risk Consultants will provide expert guidance on how to assess and defend your property and equipment values in today's volatile environment. RIMS is thrilled to welcome a large global audience, and now I will hand it off to our moderator, Global Risk Consultants Head of Marketing, Jared Shelley.
Hey, thank you, Justin, and hi, everyone, and welcome to today's webinar. As Justin said, I'm Jared Shelley, Head of Marketing at Global Risk Consultants. Today, we're going to talk about insurance asset valuations of property, such as facility buildings and the critical equipment, machinery, and assets inside. We're thrilled to be here with members of the RIMS community, risk managers, insurance professionals, and industry leaders who know firsthand how critical accurate valuations are in today's property insurance landscape. Getting values right is no easy task, especially in recent years when inflation and supply chain issues added serious complexity to the equation. Now tariffs and economic uncertainty are adding new obstacles. But thankfully, we have three knowledgeable, experienced people to walk us through it all. Justin Chen is Global Manager of Property Valuation Services at Global Risk Consultants, and he works with some of the most well-known companies on their valuations. Natalie Harper is a management consultant at GRC. She works with big companies on valuations and has been in the field for more than 20 years. Charlie Carriker is strategic sales manager for project services at GRC, and he is an expert in risk engineering and loss control with more than 20 years of experience. And like I said earlier, I'm Jared Shelley, Head of Marketing at GRC. Okay, so during this session, we're going to break down why insurance asset valuations are more important than ever, how inflation, tariffs, and supply chain volatility are impacting values, and what that means for your risk strategy. We'll share a brief but fascinating history of valuations, from the Great Fire of London to post-COVID pricing volatility. We'll offer real-world stories of companies navigating today's challenges, best practices for assessing multi-site portfolios and complex operations, and how to use valuation insights to strengthen your collaboration with brokers and underwriters. So here's the format for today's discussion. I'll act as the moderator, asking questions of our panel. If you have a question, put it in the question box on your screen, and we'll answer it at the end of our presentation. We want this to be interactive, so get those questions in. Okay, now for my first question, and it'll go to Justin. Justin, very basically, what are we talking about today, and what are we not going to talk about today?
Thanks, Jared. So we're going to start off with talking about your property insurance policy. I'm sure most of you have seen the formula premium equals value times risk. And we're going to sit here today and talk about the value side of that formula. There's a lot of different types of value that can be reported in your reported values, your statement of values. And the most common or most typical property insurance policy is talking about replacement cost new, which is the cost to rebuild or replace something in like kind or like quality. So here are some examples of some other values that can be reported, but aren't really what we're looking for. Again, we're looking for that replacement cost value, but it can be very muddy of what's actually being reported. And one of the questions we like to ask when we start client meetings or talk about values is, where did your values come from? Are we actually talking about replacement cost value, or are we talking about one of these other values? Typically, there's not one person in your finance department that comes up up with replacement cost value. So to get the right value is fundamental to reporting for your property insurance policy.
Great, thank you. And Charlie, let's go to you for the next question. Tell us a little bit about the history of insurance asset valuations.
Sure, Jared. Yeah, when we started looking at doing this webinar, we looked back at the history. We identified about three specific events that have helped evolve the pathway of insurance asset valuations through the years. The first one, I think you mentioned in your introduction, was the Great Fire in London. What we saw came from that was that it sparked the need for formal property insurance valuations. During that event, about 80% of the walled city of London was impacted by by this Great Fire. Also, in addition to that, about 13,000 homes, 87 churches were all impacted over this 4-day event. When we move on into the 1700s, we see that there's an industrial revolution starting in Europe, expanding over into North America. We started replacing or adding machinery into our manufacturing processes. So in addition to the building value, companies also had to start taking account into their contents values. So during that industrial revolution, there was a significant change that also wanted to focus on the contents portion of the appraisal in addition to the building. The last event that we want to highlight today is the 1906 San Francisco earthquake. While the earthquake gets a lot of the attention, actually it was the fires that were associated with that quake that caused most of the damage. Again, about 80% of the city was impacted from this. And what was pointed out is that there was underinsurance or inaccurate valuations for a lot of the facilities that were impacted that caused a large amount of litigation going forward. Spawning from that were co-insurance clauses that were introduced to penalize low or underreported values. That's something we even see today, but it all sparked back from that 1906 event. So what you have on screen here, Jared, is it's a great piece of history. During one of the property valuations that our team was performing, the client actually had a copy of this pamphlet. The pamphlet, if you expand it and we look at the middle section there where it talks about the suggestion, we see that this pamphlet was around 1919. So it was shortly after the events that we just covered on the previous slide. But what I find very interesting in this is that even in 1919, they're in the middle, the suggestion. Number one, they're wanting to make sure that their clients know their values of their buildings. Number two, making sure that they're carrying enough insurance. And then even number three, we see that they're also or already referencing property risk engineering, ensuring or encouraging the clients to take adequate steps to prevent fire. So this cool little piece of history is something that we like to go back to say that, you know, things are changing, things are evolving, but a lot of the basis is still the same, even from back in 1919.
Yeah, pretty cool to see that. And Natalie, can you give us a little bit of the more recent history, maybe COVID to inflation to now?
Thank you, Jared. Sure. Basically, from about 2019 until 2023, insurance values in the property insurance market saw significant changes driven by, as you said, Jared, inflation, climate risk, supply chain issues, and labor shortages. The increases were even up to about 35% in some cases. Construction cost inflation surged during the pandemic, which increased the supply chain distribution and labor shortage. Material costs like steel, concrete, lumber increased sharply, thus leading the insurers to reevaluate every replacement cost that came across their desk. By 2022 to 2023, many properties were even found to be uninsured due to the insured values not keeping up with the pace of the rapidly rising building costs. Insurers were encouraging policyholders to reassess their property valuations to ensure adequate coverage, and valuation accuracy became a core focus, with many insurers requiring third-party appraisals. And the most common reason that a lot of companies never did that because they didn't think anything changed, and as well as they were trying to keep their insurance premiums down. And it just proves to show that I had a client had properties that was severely damaged by a storm, and due to the lack of their keeping up with their building replacement costs, they only recovered half of what they should have if they reported the values correctly.
Wow, that's incredible. Justin, let's go to you for the next question. Why is it so important to get this right?
Yep. So as we were talking about throughout the whole presentation is getting your values right, figuring out what that replacement cost value is and why do we want to do that? Well, what the number one reason is protecting your assets, right? So if you have a loss, you want to make sure you're covered for those assets and being able to come back up to business and feel comfortable and understanding your risk. We also want to build trust between all the parties. We want to build trust between the insured, insurers, brokers, everyone, reinsurers to make sure that they understand what risk they're putting up. So all this rolls into that better decision making strategies. You're able to look at your accumulation of nat cat exposures, retention, reinsurance analysis. On the risk engineering side, you can build better loss scenarios and also better estimates of risk improvement recommendations. You can start looking at your appraisals or your values and determining, okay, well, this is my loss scenario. Now I know what's in that area to define that loss scenario or the value that's there. So it just allows a little bit more comfortability of your values and the risk exposures that you're putting yourself into.
And then tell us about the consequences of being underinsured.
Yep. So as we were talking about the history of property insurance and that pamphlet that we saw, one of the things is the coverage gaps, co-insurance. We started to see that during COVID where we realized that there are underinsurance, and ways to combat that is to write those co-insurance clauses and not having, putting yourself at a higher risk of, if we have a loss, now we have to pay this out of pocket. Do we have enough assets? Do we have enough cash to be able to rebuild and put us to where we needed to be? So we had that financial distress. You had that limited coverage of that gap as well. And of course, you want to make sure you're replacing your assets with like kind and quality and looking at that the best you can to say, hey, I'm protected. Let's get the values right there.
And then let's get into some real world examples here. Natalie, do you have an example of maybe a client or a company you know that where doing the valuations and getting all the costs and everything right worked out well?
Absolutely, Jared. I worked with a client who lacked some documentation on how they initially discovered and did their property values or how they were established. And as a result, the insured questioned their credibility of those figures and then arbitrarily escalated those insurance values. Not only did this increase their premiums, but also created uncertainty around their reported data. And once the client obtained formal third-party appraisals, they were able to establish and substantiate accurate valuation within their book or their statement of values. With that appraisal in hand, they were able to present that to the insurer, which led to a reduction in the cost of risk and gave them greater confidence with the accuracy of their reporting. So regular appraisals help avoid issues like premium increases and paying out of pockets for uninsured losses.
Great. And Charlie, do you have an example, maybe a negative situation where a company maybe was a bit undervalued because they didn't have the valuations in order?
Yes, similar to Natalie's earlier example, where one of her clients wasn't able to recoup all the money from a loss incident. I recently worked with a company with a fairly large portfolio where their values had not been updated in quite a while. Typically, from pre-COVID to now. But what they noticed, or what actually Justin noticed as he was doing a square foot analysis, was that there were inconsistencies within the different occupancies. The same occupancy was valued at one value in one location as opposed to a much higher, much lower in a different location. So working with Justin and his team, we were able to prepare a plan for the client to get some more in-depth analysis, whether that was a desktop or an on-site survey. And their values would have been grossly undervalued if there had not been that deeper dive into it with the individual analysis.
Right. So Justin, let's get to the topic on everybody's mind, tariffs, and really what is the current state of valuations given the current tariff situation?
Yep. So kind of like Natalie was talking about before with COVID and the pandemic, that we saw record highs in inflation, that 45% increase in construction costs since 2020. But the content side really stayed pretty stable, that 15% over the since 2020. So we're looking at 3 to 5%. After COVID, we started to see things stabilize a little bit. We're seeing that 2 to 3%, 2 to 5% increases in construction, and the same for contents. Tariffs, on the other hand, has created this uncertainty. It's a fluid situation. Things are changing frequently. So we're anticipating a lot of increases in both real property and personal property. The tariffs we understand is that it's going to increase material costs. It's creating an uncertainty that these construction companies, these companies that are selling your machinery have to take that into account somehow. So they're increasing costs to combat their uncertainty. We're thinking in the next 6 months that there's going to be probably at least a 3 to 5% increase in construction costs. And then contents, I would say it's probably at least the same, if not more, just depending on what you're trying to purchase and what you're trying to get delivered to the US. It also creates supply chain issues. Again, same kind of thing that COVID did is supply chain issues, causing delivery delays, which can cause project delays, which also increases your construction and project delays. So your labor increases, and your project increases. So, I think at this point, it's really good to kind of keep track of what's going on with the tariffs, how it's going to impact your projects, and stay active in keeping your values up to date and looking at them maybe more often than you normally would. We recommend that 3 to 5 years. Let's look at it every year or even quarterly, just to keep track of what's going on and seeing how things are changing with the current economic conditions.
Right. So the more fluid the situation, the more often you should get a handle on your values. Let's go to Natalie here for the next question. You got calls from clients all the time about this and obviously other issues. What drives their need for updated valuations?
Well, mostly the insureds are pushing for that. And like I stated earlier, they're pushing back on what their statement of values is stating. A lot of, in my previous history as a broker, a lot of times underwriters would come back and just say, we can't accept these. The square footage is way too low. And a lot of people have an uncertainty of where these values started, like I said earlier. And so really, getting these appraisals just solidifies that information that you're providing to your underwriters, that you have an obligation to do that. I mean, because of the fact that they're insuring your values for replacement costs, they expect you to get close to that area of 80%. And so I think that in general, as well as a lot of clients these days want to own their own information. They want to know what's going on with their values and what indices they should be increasing per year. So I think it's a twofold with, again, pleasing that their insurance partners, as well as having their own accountability for their information.
Absolutely.
Another item that we see that kind of drives that need for valuations is, technology is changing as well. Many industries are seeing an influx of new technology, whether that's AI generated, whether it is just newer machinery for efficiencies. Oftentimes, a building expansion project is going to be very visible. It's going to be very well known and doesn't get overlooked in the statement of values whenever they come in. But if you've had a major renovation in the technology, it's very good to reassess your contents values. This new technology with the increased efficiencies often comes at a cost. So whenever we're chatting with clients, we also want to find out not only what type of building expansions, but what type of internal changes in their processes are going on.
Hey, thanks everybody. Let's go to Justin here to get sort of some understanding of how this works more detailed. So explain how you assess critical pieces of operations like equipment and machinery, not just the facilities that house them.
So what we like to do on an on-site visit is walk through the facility, inventory equipment, go through production lines, and we try to break it up into production lines. And we'll say, okay, well, let's take the example of this photo here, the robot that's basically picking up items and packaging them or doing like a palletizing function. You can get the cost of the machine from the asset listing, original purchase cost, and things like that. But does that asset listing also include the installation of the machine, the freight and delivery, the engineering that goes into that whole production line, right? You have to have your conveyors at a certain speed. You have to have, it transfers from one spot to another. Is there a bottleneck somewhere? So all this engineering and things that go into the cost of your production line might be hidden somewhere that's not in your asset listing. So you want to look for that and have those discussions saying, hey, I bought the robot arm for let's say $500,000, but it could be a lot more when you include your installation, engineering, freight, delivery, and startup costs. So, those discussions need to be taken into account. And, again, you're trying to get back to where you were in case of that loss. So you should include those type of values into your replacement cost.
Yeah, it makes a lot of sense to me. So can you explain the process of assessing a large portfolio?
Yep. So Charlie gave the example that we like to look at the statement of values, break it into occupancy, square footage, and then do a dollars per square foot. We usually look at buildings just because they're a little bit more, I guess, standard, easier to assess. And then we just start doing and looking at it and saying, hey, we have benchmarks. We've seen these type of buildings before. We know where the dollars per square foot should kind of benchmark at. We use our in-house data and then we say, okay, let's red flag this. Let's have a discussion and talk about why there might be a discrepancy or why there's might be inconsistencies. Let's talk about it because we know that there can be lots of reasons why that is flagged. It could be incorrect data, square footage is wrong. Could be a breakout of occupancies. We have one building. It could be your manufacturing, it could be warehousing, it could be office. Trying to break it up and just have those discussions and say, hey, we're not trying to say your values are wrong, but let's talk about and see if there's a way we can kind of consolidate, figure out a way to get those values correct.
And then can you explain the difference between on-site and desktop valuations?
I'll take this one. While full on-sites remain preferred approach for high value assets, desktop assessments can continue to prove significant value, particularly in locations that are physically difficult to access, especially if you have a large global portfolio where you're having to go to remote areas that are hard to get to, and you just need to understand what assets you have there. So that's where desktop can really become very helpful. Also, a lot of clients don't want to have to pay for the full on-site appraisals, so they utilize a desktop appraisals to kind of offset that cost. And when we look at the statement of values, within Justin's group, we can provide a statement of values, and Justin can assess that with a red, green, or yellow analysis to kind of give the client a ballpark of where they're at, if their values are adequate with being green, if they need a little tweaking yellow, or if they're way off the mark in a red category.
Absolutely. Charlie, do you have anything to add?
Absolutely. So as Natalie explained the differences between the two, it's not an either or scenario. I think it's good to keep in mind that a combination of these is often the best approach for a client. It allows them to get a detailed analysis, an on-site assessment for select facilities, and then take the information that Justin's team learns through that that is specific to their operations, and then apply that as a desktop appraisal to other similar occupancies with their own portfolio. It's almost indexing using their own data, which is becoming more and more, uh, gives you a more accurate representation of your own internal portfolio. So it's always good to keep in mind it doesn't have to be one or the other. And especially if you have a larger portfolio, it's a way to maximize the results of your capital expenditure.
Great. Well, thanks so much. I'm going to do a quick recap, but I want to remind everybody to ask some questions. Add the questions to the question box on your screen. We're going to get to it in just a moment. So, but here's a brief recap of what we learned today. Insurance asset valuations are critical in today's business climate. Valuations are still very important despite market softening. On-site valuation provide the most concrete support, and we just heard all about the differences between on-site and desktop and how they work together. Underinsurance is a risk that you don't want to take. Valuations have been a big issue for years, even in the early days of the insurance industry, as we learned with that fascinating history that Charlie gave us. And then work with risk engineers to get values right, and work with brokers to analyze a portfolio or risk program accordingly. So that's our program for the moment, and we'll get to Q&A in just a moment. Okay. So we're here. We have Justin Chen. We have Charlie Carriker. We all listened once again. I know it's always weird to hear yourself, right? But we've got some great questions from the audience. So please continue to send those questions in. Let's get to the first one now. So this one, for custom built or specialized machinery, what's the best approach to determine a fair insurable value when market comparables may not exist?
Yeah, so typically what we would do is sit down with the engineers or the plant production people and just discuss what went into the custom machine, what they purchased it for originally, and then we can add in either indices or just discuss, hey, if I had to rebuild this today, how much would it cost? With anything custom, it's going to be more than off the shelf, and not knowing all the details, you just have to sit and discuss it and do your best to figure out that replacement cost.
Sure, I can imagine. So what level of detail is enough for, quote, enough for supporting valuation numbers during underwriting or maybe during underwriting negotiations?
I think that just depends on the underwriter or who you're preparing the report for. We usually try to be upfront at the beginning and show different report formats of what we can do for detail and kind of the budget that you have. If we're doing an inventory of every single piece of equipment, let's say an office, you're counting, hundreds of chairs or hundreds of desks. I don't think you need that much detail typically. So we'll group in usually the smaller items, and then we'll say, hey, assets that are valued over 250,000, we'll do a line item or we'll describe that item. So for example, that palletizing robot, we say one palletizing robot made by whoever, here's your model number, and then we would give a replacement cost for that specific item or system. So that item would be, $250,000 or up is typically what our cutoff is, unless specified by the client.
Great. When is the right time in the insurance cycle to commission or revisit valuations to have the biggest impact on renewal outcomes?
Jared, I'll jump in on this one. And, starting early is very important. Whenever you're trying to prepare for your submission, we would recommend that you contact the team around 6 months prior to your renewal to make sure that there's plenty of time to get the valuation scheduled, get the report in hand, give you a chance to review that, as well as put that together with the other information for your submittal to the underwriting team.
Great. Here's another one. What tools or programs do you use to determine that values are current?
So we usually start in that top-down approach, what we call a service profile, and we'll look at your statement of values and do a rough dollars per square foot and just kind of compare it to our in-house databases, what we know from our experience of what buildings should cost dollars per square foot. And then we flag those and have discussions about them saying, hey, we're seeing you're reporting $20 a square foot for this building. Our expectation would be in the $80 per square foot. Is there maybe something wrong with the data that's coming in? Square footage is off. Maybe it's just a shed in the back and that number's right. So we start that way with our in-house databases. When we start doing valuations or on sites and comparing numbers and buildings, we try to measure out the buildings for gross square footage. We take notes on the construction, roof, floor, walls, interior finishes, things like that, and we'll use construction manuals to try to rebuild that building as a model of as close to as possible as your building, or we'll use a model that we've developed in the past saying, we know this is an office building, we've done this in the past, and we can come up with replacement cost value that way.
Sure. Here's another. How does valuation tie into broader risk engineering like fire protection or natural hazard mitigation in terms of presenting a complete picture to the risk managers and as well as the underwriters?
Well, the valuation, Jared, is the basis for your loss estimates. It's the basis for the recommendations, and then giving you an accurate picture that you can convert over into dollars and convert into what that loss would actually look like. So when we're preparing the risk engineering, we can use the values that are determined in order to show you what risk mitigation, what type of risk reduction you're actually going to benefit from the risk engineering side. So really having an accurate value, it's the cornerstone for a good program because everything else is based off of that.
Yeah, it sure makes sense. Well, I just want to thank you, Charlie, Carriker, Justin Chen, and also Natalie Harper, who couldn't be with us for the Q&A, but she was incredible as well. And I'm just going to hand the program off to Morgan from RIMS for a final word. And thanks for everybody for listening. Really appreciate it. Our contact info is up here on the screen if you'd like to have a chat afterward. We are certainly willing, and we'd love to hear from you. But now we'll just give it to Morgan for a final word. Thanks, everyone.
Thanks, Jared. I want to give special thanks once again to Justin Chen, Natalie Harper, Charlie Carriker, and Jared Shelley of Global Risk Consultants for their time and their expertise. Please note a copy of this webinar will be archived on rims.org within a few business days. And notice there's a lot of resources for you to access, so you can find them all at tubesud.com/GRC. You can see that down there. You can also connect with Global Risk Consultants through their LinkedIn page, so check that out. Finally, RIMS is global, and we'd love for you to build your network with us, so visit rims.org/membership to apply for a RIMS membership if you haven't already. Otherwise, thank you all for attending, and stay safe out there.